Hello and welcome to Chapter 16 on the bond markets. So first of all, we talk about the different types of bonds, and we start off with the ones that are issued by governments. These are known as government agency bonds. Governments have need to issue debt in the form of bonds. Why? Because most governments run budget deficits. Of course, if they ran budget surpluses, they could purchase some of their debt back. Incidentally, the sum of all the bonds issued by any government or any country is equal to that country's national debt. So, governments have to fund their spending by issuing debt, particularly if they run a budget deficit, as I pointed out. Now, you're probably thinking, well, wouldn't it be good to be a government or in a country that runs a budget surplus? We'd never have to issue any debt, any bonds. The honest truth is that even in countries that run budget surpluses, there are bonds available to purchase, and the treasuries of those countries often still issue bonds. Not many, but they still issue bonds just to keep a credit rating in the market. It's the same for individuals, Even if you don't use a credit card, having a credit card increases your credit if you want to get another type of loan, or if they look at you, for instance, for a mortgage or for a car loan or any new type of loan. The fact that you already have a credit card, even if you don't use it, is to your benefit. So having some bonds out there means that those bonds get rated, and that means that the country can have some kind of standing in the international credit markets. That's what they're called. So bonds are usually issued to make up for the shortfall of tax revenues when spending is greater than revenues. In other words, when the country is running a government budget deficit. Current spending is funded by future tax revenues. Of course, we're in that situation right now in the US, where we're going to be, because of the COVID relief package that the Biden administration has proposed and wants to pass. If it gets passed, then obviously we're going to be spending way more than is coming in taxes. That means it has to be funded. So the government bond market's already braced for a large increase in bond issuance. But at the same time, the Biden administration is looking to increase taxes on corporations, so corporate taxes rising, and taxes on the very rich rising as well, to cover some of that spending. So bonds that mature between 1 and 10 years are usually called treasury notes. I still call them bonds as well, actually, but officially they are called treasury notes. Any bond that matures greater than 10 years out is called a treasury bond. So it's actually bonds, if you want to be very precise, bonds are those pieces of paper that have been issued as IOUs by the Treasury, by the government, that have a greater than 10-year period to maturity. To be honest, though, certainly in the media, they still talk about 10-year bonds and 5-year bonds. So officially, they will be really called 5-year notes, treasury notes. But I think you should be able to go between the two. They're used interchangeably, those terms. So those treasury notes and bonds pay relatively low interest rates. In fact, some of them, in some countries, are paying negative interest rates right now. So the German Bund, which is a bond, Bund is the German for bond, that pays a negative interest rate right now. There are other types of government bonds out there. There's these treasury inflation protected securities, so they're called TIPS. They were first issued in 1997. And as inflation increases, the real rate of return decreases, of course, because you know that the real rate of return is the nominal rate of return minus the rate of inflation. So as inflation goes up, ceteris paribus, then the real rate must come down. And that causes bonds to have a lower rate of return. So what the TIPS bonds do is that they index for inflation. So the bondholder is protected from increases in the rate of inflation in terms of the coupon that they get. So the higher the level of inflation, the more that coupon's going to increase. And there are such things as strips as well. These are separate trading of registered interest and the principal of the securities. So in other words, what you can do is you can take a bond and you can divide it into two bits: the coupon payments and then the principal itself. Of course, with any bond or note, they often trade at a discount or at a premium to the price, because the price would be as if interest rates were exactly the same as the coupon rate, and invariably they're not. So that means that you could trade the two separately. Obviously, if you get lumbered with a bond that's at a discount to its face value, that's fine because you make up the difference over time. It's not so good if you get a bond that's actually at a premium compared to its face value. That means its price is above its face value. In other words, you're going to make a loss through time, likely, because the price has to come down to the face value. So that's government bonds. Some people call those sovereign bonds as well. Those two terms are interchangeable, as you're going to see. And then there's government agency bonds. So any government agency can issue bonds. So for example, there's Ginnie Mae, which is the Government National Mortgage Association, or Fannie Mae, which is the Federal National Mortgage Association, or Freddie Mac, which is the Federal Home Loan Mortgage Corporation. They were initially established to help people, to help provide liquidity to the mortgage market. In other words, to help people get mortgages and therefore to help people buy houses. This is part of the so-called American dream, which is the idea that everyone is able to, anyone is with a job obviously is able to purchase a house. So these institutions basically are a means whereby particularly first-time home buyers can get lower interest rates and therefore buy the property that they want. Then, of course, there's municipal bonds. These are bonds issued by municipalities. Because they're federal income tax exempt on the interest paid, they tend to be issued at a lower interest rate because you're basically getting a better return, because you don't have to pay tax on that interest rate coming when you declare that at the end of the year. And that's because state and local governments issue bonds to borrow money to fund expenditures. And there are two types of municipal bonds. There's the general obligation bonds. These are a bond issued and backed by a state or local municipality to raise funds. They're going to be used for a wide variety of different public works projects. So in other words, they're not earmarked for anything specific. And then there's revenue bonds. These are bonds that are issued and backed by a state or local municipality to raise funds that will be used for a specific income generating project. When, for instance, the university builds new buildings, it asks the state to issue revenue bonds on its behalf in order to borrow the money to put the building up. So, for instance, the building which we're in, as the College of Business, which is the O'Connor building on the campus, that was funded partially through alumni donations and a generous gift from the O'Connor family, but also through a revenue bond. federal income tax exemptions or on muni bonds. I think we talked about that already. And of course, that means that the equivalent tax-free rate is equal to the taxable interest rate times 1 minus the marginal tax rate. So in other words, what this does is say, okay, my marginal tax rate being the tax that you pay on an extra dollar. So it's saying, you know, if that interest was coming in, that you would be taxed on that interest at a certain rate. Well, that rate is your marginal tax rate. So we take that taxable interest rate and we multiply it by 1 minus the marginal tax rate. Basically, that gives you the equivalent tax-free rate. And although muni bonds are issued by state and local governments, they're not risk-free promises to repay. There have been bankruptcies of municipalities, most famously New York, back in the 1980s, I believe, Orange County in California back in the 1980s, and more recently, Stockton County in California as well had to declare bankruptcy. And also Detroit, of course, famously declared bankruptcy on its muni bonds. Now, if a state or local municipality declares bankruptcy, then those bonds are basically worth nothing. That can be problematic. Now, those general obligation bonds are usually viewed as having a lower default risk than the revenue bonds. The revenue bonds depend on the revenue coming in to fund from that particular building to fund those bonds. That's the idea. Now, in the university, it's a little different with our revenue bonds because obviously the funds come from our tuition fees and in a way from the funding that the university receives from the state. So, you know, some of the funding that the university gives the state, the state gives to the university just turns around and gives that money back to the state. So let's now turn to, now we've done with government bonds, let's turn to corporate bonds. So what are the characteristics of corporate bonds? And quickly, I just want to kind of backtrack a little bit and give you the bigger picture here. When it comes to funding for businesses, the source of funds is kind of important. In other words, where an expanding company gets its money from in order to expand, in order to invest, in order to build capital in the business. Well, a lot of people think it's from the stock market. And of course, the stock market does have an incredibly important function, as we're going to see in the next chapter. But in fact, corporate bonds are a much more important source of funding for companies than are stocks and shares. In fact, corporate bonds are the number one source of financing for companies compared to any other source, bank loans, anything else. So the corporate bond market is very important. And these corporate bonds can have unique characteristics. In other words, when we look at the class of corporate bonds, it depends on the bond issuance, and that can depend on the corporation itself as to the features that the bond has. So this differs quite markedly, by the way, from sovereign bonds, government bonds. So first of all, we can have bond covenants. So a portion of a bond agreement that specifies what the borrower, the bond issuer, may or may not do during the life of the bond. So bond covenant can actually limit what the company does in terms of its actions during the life of the bond. Some of these have call provisions on them. That's a clause in the bond contract that allows the issuer of the bond the right to buy back all or part of the bond issued before the bond's maturity date. So often companies issue bonds, 20-year bonds, for instance. Well, most companies won't issue bonds that long, but Apple has done recently, for example. And they might say, well, after 10 years, we don't want to have this debt anymore. We've made enough money. We've got some money sitting here from our revenues from selling our product, we're just going to kind of cancel this debt, because it is a debt as far as companies are concerned, of course. So that can be a call provision. Indenture. This is a legal contract between the bond issuer and the bondholder or the purchaser. The contract lays out the legal requirements of the borrower or bond issuer. So this can be kind of an addendum to the bond issue, which shows exactly what the legal standing is of the bondholders. Often that relates to default. So if the company defaults, what rights do the holders of the bonds have? Sinking funds. This is a pool of money set aside for repayment of the bond. So in some cases, the indenture will have a contract. In the legal contract, there will be specification for a sinking fund. And convertible bonds. Some bonds have clauses which specify in the indenture a conversion that will take place at a certain time. Sometimes it's mandatory, sometimes it's optional, depending on what the bondholder wants to do, to convert the bond into a specified number of shares. So convertible bonds are often seen as very good kind of investments because you get to own shares at a certain point in the future, and you also get some guaranteed return now. So if a company is in its early stages of growth, they often issue convertible bonds, particularly mid-sized companies, because this is a good way to entice investors by basically taking on debt first, which you can basically repay by issuing new stock. So it doesn't burden the company any, and the bondholders themselves get to enjoy growth in their company once the stock prices take off. Convertible bonds, we've looked at those already, but they are growing in importance in the US economy. For instance, one of the mutual funds that I own is a convertible bond fund. And of course, it holds some bonds that are convertible bonds, and it also holds some stock because some of those bonds have already converted into stock. Next, we're going to talk about bond ratings. Bond ratings are done both for sovereign debt and for corporate debt. When did they start? They started in 1909 when a financier called John Moody started offering bond ratings on the potential of default for companies in particular. The Moody's rating system was simple, straightforward, and easy to use. It was a huge success. And in 1916, Poor's Publishing Company, which eventually became Standard & Poor's, S&P for short, which is now owned by McGraw-Hill, interestingly, began offering its own bond ratings to investors. So that's two sets of bond ratings. And then Fitch Publishing Company, which was founded by John Knowles Fitch in 1913, began offering its own letter grading system of bonds in 1924. So the three main ones that are looked at are the Moody's rating system, the S&P rating system, and the Fitch rating system. Initially, this bond rating agencies, they earn their income by selling manuals full of financial data. Later, instead of charging the buyers of the bonds for the bond ratings, because there was a problem basically in keeping those ratings secret, the agency started to charge fees to the issuers of those bonds for these instruments. So, in other words, if you issue a bond and you want it to be rated, then you have to pay for it. Now, it's created a conflict of interest, of course, because as the issuer pays, then if the issuer doesn't like the bond rating it gets, then it can ask for its money back, or it can just not pay and go to another bond rating agency. So how much does reputation matter to the bond rating agencies is a good question. And in the last financial crisis, the bond rating agencies played an important role in the kind of rollout of the crisis, because what they did is that they were asked to provide ratings for mortgage-backed securities. So basically what this was a piece of paper which was backed by mortgages which had been bundled together. They decided to give AAA rating, in other words the highest rating possible, to these mortgage-backed securities or MBSs, when in fact the mortgages that were backing up those bonds were not good. They were subprime mortgages, so they were not the best quality people who were borrowing the money. And of course, when the housing market went south, many of those mortgage borrowers couldn't pay. So that meant that the bundles of mortgages that were backing up the MBS were defaulting. So not only were they not paying the interest rate that they should be, and then monthly payments, but also they were defaulting and not paying going forward. So that created a real problem. So in the wake of the most recent financial crisis, there have been more calls to reform and regulate those bond rating agencies. Each of the three bond rating agencies has a slightly different way of evaluating the bond issuers, and each bond that is rated is given a letter rating. In addition to rating the bond issuer, the bond rating agencies also sound an alarm if an issuer is about to be downgraded. So, in other words, they issue a press release which says, we are downgrading the bonds of IBM or whichever company it is. By the way, it's mostly large corporates that issue corporate bonds. Small companies will not usually be able to find someone to underwrite. In other words, guarantee the issuance of any bond issue for the corporate bond issue. For Moody's, this system is called under review. For Standard & Poor's, they all have different names for these things. You can see it's called a credit watch. And for Fitch, it's called a ratings watch. So a downgrade in a bond rating can cost an issuer millions of dollars because issuers with a lower bond rating have to offer a higher interest rate to borrowers to offset the increased default risk. So in other words, if you get a downgrade in your bonds, it's going to be rather more difficult to borrow money from anyone else or to even issue bonds of the same caliber as the ones that are already out there. And here is another slide talking about the bond rating debate. The model changed as ratings agencies started to rate lots of different types of financial instruments. So the ratings agencies also rate commercial paper, preferred stock syndicated bank loans, and CDOs or collateralized debt obligations. That's basically a bunch of debts, loans that have been bundled together. The new model was such that the issuer of the financial instrument paid the rating agency, as this tended to attract a greater degree of interest on the part of the financial investors. And we've already said it's a conflict of interest. Okay, when we talk about a flight to quality, what do we mean? And we often hear this in the financial media. Well, if there's some kind of geopolitical event or there's a scare about something in the world, so inflation, for example, or maybe the oil supply being cut off or curtailed, then you often see this so-called flight to quality. One of the things about government bonds in particular is that they seem to be risk-free. US government bonds I'm talking about. Of course, it depends on the country that's issued them. Many countries have defaulted on their bonds, by the way. Argentina is probably the most frequent bond defaulter in the modern era. But if we go back to, for instance, the Civil War era, the US defaulted on its bonds back then in the 1860s. So when we see a flight to quality, we see investors pulling their money out of what they perceive to be riskier assets. So that might be stocks, or I don't know, some other kind of asset, and putting it into government bonds. And of course, what does that do? That increases the demand for bonds, and you know that increases the price for bonds, and it therefore has a kind of a nice safety mechanism on the economy as a whole, because it then therefore reduces the yield on those bonds. So that's what happens. And of course, reducing the yield means that interest rates in the economy tend to be on a downward trajectory, and that stimulates investment and stimulates the economy in general as per monetary policy. It also affects the commercial paper market. So flight into quality can often mean that investors get out of commercial bonds, for instance, particularly if they think a recession is coming. And it can affect the municipal bond market as well. It means usually that money flows not only into federal government bonds, but also into these munis as well. And it's not just in the US. Global flight to quality, can be that investors around the world pull funds out of riskier debt markets and into safer markets. So it might be that you have bonds in, South African debt. So you might have some South African bonds. Well, you might think that in the next downturn that South Africa might be having a much harder problem to weather that downturn. So why not just pull out of that developing country and into a more secure country, and so buy Swiss bonds instead, for example, or US bonds. Right, to end this chapter, what I want to do is look at the bond markets in figures. So this is from the Association for Bond Traders. It's not called that, it's called the ICMA, and I forget what that stands for. But in any case, this is some charts I took from their website. So the first one shows the percentage of, or the number of bonds outstanding, which is $128 trillion around the world. And you can see that we have two different categories here of bonds shown in this pie chart. We have SSA, which is the blue area of the pie chart. SSA means sovereign and sovereign agencies. So that's government bond issuance, basically, is the blue. So it's about 2/3 of it. And then the orange part is the corporate part. So that's the orange part there. So in fact, when we look at the total bonds issued around the world, 2/3 of them are government bonds. We can split this down by country as well now, and we can split it into, we can see the split that they've got here: sovereigns, government regional. So there's parts of some countries that allow regional governments to issue bonds. So for instance, in Canada, the Canadian provinces can run budget deficits or budget surpluses, and therefore can issue bonds. In the US, that doesn't tend to be very common, and most state legislatures have a balanced budget provision, which means that they have to balance their budget, and therefore they don't issue many bonds. So you can see in the US column there, the third one along, you can see that most of these bonds are issued by the sovereigns or the government agencies in the US. Very little is issued otherwise than that. You can see government agencies. There is the yellow area. And then you've got supranationals. That means above the national level. So that's happening now in Europe, by the way. And central banks can also issue bonds. They don't do that very often, though. Local government, you can see there in a different color blue. And then winding up agencies, it's really not important at all. So let's look at the size of the charts first of all. You can see that US has the most government bonds issued in the world. Then China, interestingly, not far behind at all. So very close behind. By the way, this is as of August 2020, so it is a little bit out of date now. We've been issuing quite a lot of bonds since that time. Then comes Japan, and Japan has one of the largest issuances of bonds in the world compared to its GDP. So it has compared to GDP, Japan is the highest percent, I believe. Now, looking at some of those others, we've got CA is Canada. You can see the Canadian provinces and the federal government pretty much equal issuers there. Korea, that's South Korea. India issues a lot of bonds. Got DE is Germany, so going along from left to right here. Italy has issued a lot of bonds, and France, and then a whole bunch of others. And of course, the UK will be in that column there, where it says the whole bunch, to represent the whole bunch of others. Let's look at the corporate bond market. And you can see that, when we're looking at corporate bonds, the US is way ahead of nearly any other country. So this kind of bears out what I had to say before about US corporate bonds being a major source of finance for US corporations. Notice that that's not the case everywhere, right? So, for example, in Germany, most companies will go to banks to borrow money first. That's the first source of financing. Then corporate bonds, and very last, the stock market. In the US, it's corporate bond market, then the stock market, and then other sources. So it really differs by country. And here in below, he split it down into the different sectors where the companies that have issued those bonds originate from. So you can see in the US, financials are the biggest sector that issues corporate bonds. Same in China, for that matter, and in Germany as well. CH, by the way, the fourth column along there is Switzerland, CH. IN, India, Korea, France, GB, Great Britain, which is the UK basically, NL, Netherlands, CA, Canada. LU is actually Luxembourg. You'd probably not know that, such a small country, but of course they have a large number of European banks that have set up there. And international banks for that matter, because they seem to have very relaxed banking laws. They're a banking center. Japan then, Austria. Gosh, I can hardly read those ones down the other end of the. But anyway, you get to see where they are. Norway is the last one, by the way. And what's interesting here is this is the global bond issuance, so this is all bonds. You can see that there's been a big surge in bond issuance right at the end in 2020. That was the US, by the way. So we'll likely see that come back. But the trend is definitely up. There's no question about that. And here, we don't have this for the US by state or anything, but for Europe, we do have it by country, which is kind of interesting. These are not corporate, these are government bonds. So SSA means sovereign and sovereign agencies, bond issuance in Europe. So you can see that Italy, France, Germany are the big bond issuers are in Europe and in the UK as well. In the UK, by the way, they call their bonds gilts, G-I-L-T, gilts. And then Spain is kind of the fifth in line, and then most of the other countries have very little in terms of bond issuance, mostly because the countries are relatively small, I would say, with the exception maybe of Poland there. Poland's actually quite a big economy. Some have remarkably small amounts of bonds issued. So, for instance, Norway, a very small amount, considering how well off it is as a country. So, Switzerland also very, very small amount of bonds issued. Next, there's some kind of critical thinking questions where he asks you some questions relating to the course. You should be able to answer those. If you can't, then download the actual PowerPoint slides, and you'll see the answers there in the notes. I'm not going to go through those now. So here we sum up. We looked at what a bond was, the types of bond issuer, corporate bond features, other types of bonds, bond ratings and the agencies, and what the flight to quality means, and then looked at the bond market in figures. So looked at some statistics relating to bond markets and who issues those bonds and what type of bonds that they are. Thank you for listening.